Good morning, afternoon, and hello. Welcome to our webinar today, the 2018 Mid-Year Nonprofit Accounting Update. My name is Max Smith. I'm the Marketing Manager with 501c Services. As most of you all know, we are a 100% employee-owned company that provides alternatives to state-run unemployment insurance programs. We provide services to more than 1,500 nonprofits nationally. We administer the 501c Agency Trust, which offers a comprehensive suite of risk management services and multiple stop-loss protection solutions for our 501c3 nonprofit members. And we also operate UNCONDITIONAL, a first dollar unemployment insurance program, not only for nonprofits, but government entities and tribally owned businesses as well. Many of you with us today are already working with us, and we thank you very much for doing so. And if you have thought about reimbursing your unemployment, you should go ahead and contact us, and we can run some numbers for you and let you know how much money you can save by working with us. I have a couple of housekeeping items before I turn our webinar over to Sibi. If you have any questions, we will be taking questions mainly at the end. Sibi might pause a couple times during the program to answer questions as we go. You have the questions module on your GoToWebinar browser there. Please submit those as they come to you, and we will cover most of them at the end. Also, our materials are available in the GoToMeeting browser as well under handouts. Sibi's slides are there. You can download those now. We will also send them to you later today by email. So there's two ways you'll be able to get hold of those. The recertification credits for the CAE are going to be provided by Sibi's firm at Marks Paneth. So what we're going to do is there will be a post-event poll. You need to complete that poll in its entirety, and you need to tell us that you're looking for CPE. We will then process those. You need to give the folks at Marks Paneth probably about 30 days to get all that paperwork done, and then we will email you your credit. And also, for most of you all, you know that we do programming all the time. Our next webinar is going to be in August. We're taking July off, but we're going to be covering the nonprofit labor relations market in August. It'll be very interesting, especially with the Supreme Court's decision today, and we'll be talking about all of that in August. So without any further ado, I'm going to get ready to turn this over to Sibi Thomas, our speaker today. He's with Marks Paneth. He has more than a dozen years of accounting, auditing, tax, and consulting experience with nonprofits. He serves on the AICPA's not-for-profit entities expert panel and has been recognized as a 40 under 40 honoree through the CPA Practice Advisor for his leadership in the accounting profession. He's a pretty cool guy. I love working with him. So I'm going to go ahead, Sibi, and see if I can give you control of our programming. And you should be getting the link now.
Thank you. Thank you.
I do see your slides, but they're not in presentation mode yet. There you go.
Is it good now?
You might want to hit it again. And I'm getting the we're getting the notes section.
Oh, that's not good. Technical difficulties. Let me just move the screen over. Now you can see my desktop.
It's pretty organized. Nope, still getting the notes screen.
Okay. Do you want to take over the slides?
No, if you go to the display settings right there, you should be able to switch it at the top. See if you can switch. Yeah, there you go. There we go. Now we're good.
Sorry, apologize for the technical difficulties here. Welcome everyone to this webinar. So our agenda item here today is two big topics. There's a lot of changes in the accounting world. Most of you probably heard about the changes in leases, changes in revenue standards. But I think we are, going to focus on two items that are going to impact the nonprofit industry in the near term. The first item there, I'm sure most of you probably heard about this or attended some of the webinars in the past, but this is going to be the presentation of the financial statements, ASU 2016-14, This is effective for calendar 2018. So if you're a calendar year end, you are right now it is effective for you. So when you do your audits for December 31, 2018, this is the new standards will apply. If you are a fiscal year end, which means if you have a June year end or a different year end other than the calendar, it would be effective for you, for example, June 30, 2019. But one thing to think about is some of these provisions are fully comparative. So you definitely want to have this discussion internally as to how you are going to prepare for this standard. And we will go through, with some examples on each of these provisions under the new financial reporting standards. And the second item, actually, this ASU came out last week. It is clarifying the scope and accounting guidance for contributions received and contributions made. It is actually, the name really doesn't tell you the full story. It is actually more towards how you account for contributions and government grants, and that is a big piece of it. So if you receive a lot of monies through governmental funding, the guidance underlying how you recognize those government grants is going to be clarified through this standard. It came out again last week. So the first item here, which is the presentation of the financial statements, this is the biggest change since the 1990s on the financial reporting for non-for-profits. So we are, if you're a preparer of your financial statements for nonprofits, you know the net asset classes, how you present certain items, it's all going to change, and that's what we're going to go through each one of them. So again, why did FASB come out with this change? The biggest reason was to provide more clarity. I would say it is a targeted improvement rather than a complete overhaul of the current model. The current net asset classifications and other financial reporting standards have been around for a while. So it is not a big fix, but a targeted improvement which clarifies certain terms and to better tell your financial story, if you want to call it. So again, it is effective 2018 or fiscal 2019. So what are the key provisions under ASU 2016-14? We actually have 5 items here, 5 slides. These are the major provisions. The net asset classification, so there are changes in the way your net assets are classified on your balance sheet. The terms, the name have changed. We are all familiar with unrestricted, temporarily restricted. Those names are going to change. And also some improvements on disclosures related to board designated funds. Again, we will go through each of these items in detail in the following slides. There is also required disclosures now surrounding the financial viability of the nonprofits. That is the liquidity and availability. That is a disclosure item. If you are a voluntary health and welfare organization, you probably already prepare a statement of functional expenses as part of your basic financials. So now that is almost becoming a requirement. It doesn't have to be a basic financial statement. It could be in the notes. Again, we will look at each one of them. Then how you report your investment return and also on your statement of cash flows. There's a typo there. It's actually statement of cash flow instead of plans. So the biggest one, net asset classification, the current gap, as I said before, there are 3 classes of net assets: unrestricted, temporarily restricted, and permanently restricted. With the new revised gap, the unrestricted is renamed to without donor restrictions. So that is the new name. And the temporarily restricted and permanently restricted is now combined and renamed as with donor restrictions. So this is the biggest change. It is fully comparative, as I said. When you prepare your 18 and 19, you're going to change the wording right on the face of the financial statements to these new terms, and it's going to be comparative for both years. One other item that changed with the new net asset section is currently, if you have board designated funds, you are not required to disclose the purpose and amount unless it is a quasi endowment. With the new standard, it is now mandatory that you actually disclose the purpose and amount of any board-designated funds. Another item with the net asset classification, I don't know how many of you are familiar with underwater endowment funds. What that means is if you had permanently restricted funds and say like in a year like 2008 when the financial market really went down, if you had a permanently restricted donation of $1 million and you kept that for 5 years, it grew and changed according to the market. And in a year like 2008, the $1 million probably went to say like 800,000. That difference between that 800,000 and that $1 million, that portion is called underwater endowment funds. Currently in the GAAP, when you have underwater endowment funds, that 200,000 is grouped with unrestricted net assets. So you have a restricted net asset that was underwater, but the underwater portion is presented in the unrestricted column. With the new GAAP, you can actually present that difference in the restricted column itself, which makes sense, and I think that is more clear to the reader. One thing you do have to remember is even with the current GAAP, it was not as if you would transfer 200,000 to a restricted net asset class and make it whole again. That was not the purpose. It was a purely presentation purpose in the notes to the financials. So, going forward, that underwater portion will stay within the net assets with donor restrictions, which is the new name. So let's look at an example of how it would look like with the implementation. So the top chart there, that is the new names without donor restrictions and with donor restrictions. One thing I want to highlight here is the two minimum net asset classes, that is with and without, is required. You must show those totals right on the face of the financial statements. However, I would encourage most nonprofits to go a little bit more disaggregated in the face of the financials, which is the second chart that you see. So you have, net assets without donor restrictions, but even without donor restrictions, you may have board-designated funds. You may have operating reserve. You may have invested in property and equipment. So you are free to actually disaggregate the two minimum classes further to tell a better story to the reader and to make it more clear. If you choose not to do that on the face, you will still need to do that in the notes to the financials. So for example, you can see here under the second table, with donor restrictions, you have purpose restricted funds, you have time restricted funds, you also have endowment fund. That was, your fund that was maintained forever, the permanently restricted. So the name have changed, but the presentation itself haven't significantly changed other than the name, because even in the old presentation, you would have temporarily restricted and permanently restricted broken out, and you could still break out further and disaggregate them. So this is again is an example of how it would look on your balance sheet when you adopt the new standards. One thing I didn't mention in the beginning was please feel free to type your questions in. And we will stop at midway, and Mac will go through those questions, and I will be happy to answer. And we will also take some time towards the end of the webinar to go over that as well. So feel free to send in your questions. This I mentioned before, the net assets on board designated funds. Believe it or not, it is not a requirement under the current GAAP that you actually have to disclose the nature and purpose. But most of the clients that I work with, almost all my clients, if they have board designated funds, they already had a disclosure in the financial statement saying what it is for, how much it is, and how it has performed over the years. So with the new standards, now you are required to do that either on the face or in the notes. I would say most of them will have a line item on the face as board designated under net assets without donor restrictions, and then in the notes would explain what that board designated fund is for. We are still in the net asset section, so this is the last item on the net asset section. I don't know if you are familiar with this, but historically in the past or even in the current practice, I would say, is if you had received a donated building or if you received funds for a capital project, some nonprofits have taken the position that if there are no explicit restriction by the donor on the donated building, they would still put that in the temporarily restricted column just to say, okay, this building has a life of 30 or 40 years, and we are going to recognize and move this amount over the 30 years to match the depreciation expense of this building. It was almost like an implied restriction that the preparers of the financial statements actually put on this capital donated property. Going forward, that is not allowed. If you receive a donated building and if there are no explicit restrictions in writing or in verbally by the donor that the building must be used for a certain program or some type of restriction, in the absence of an explicit restriction, you have to pick the building up as unrestricted right away. You cannot do the matching of depreciation expense with release from restricted to unrestricted going forward. So currently, if you have something like that sitting in your books that you are amortizing over the or recognizing as restricted to unrestricted, now with the adoption of the new standard, you have to actually release it and pick it up right away as unrestricted or net assets without donor restrictions now. Let's go to the second section here, liquidity and availability of resources. So as I'm talking to my clients and as we are discussing this, I truly believe this is probably the most challenging section on this new standards that may take you a little bit of time to prepare this disclosure. So as some of you probably are aware, there were some in New York actually a few years ago. There was a large social service agency that actually went bankrupt. It was a $250 million organization, and everybody was questioning, okay, what happened? How can this happen? So in light of all that, the new standards actually now require you to have a note disclosure in your financial statements about your liquidity and availability of your resources. So how do you get there, and what is the requirement? The requirement is twofold. One, you have to disclose quantitative information, which is the actual numbers, and you also have to have a qualitative disclosure, that is in a narrative form as to how you manage your liquidity and availability. So how do you get there? I think the first approach is you should look at your balance sheet, you should look at your assets. It is really assets driven, it is not liability driven. So you look at your total assets and you say, okay, I have X number of million of assets. How much of that is convertible to cash within the next year? So if something is convertible to cash within the next year, that is the current assets in the current way we look at it. So if it is something financial asset like cash, investments, receivables, those would be your assets or liquid assets that you can convert to cash within the next year. Then the next question is, out of that liquid assets, how much of that is actually available for your general operations? The term general expenditures or general operations is very important here, and FASB haven't actually defined what that is in the glossary. So you can use a little bit of a judgment how you define what your general expenditures are, and how much assets do you have that are liquid to meet your general expenditures for the next 1 year from your balance sheet date. That is liquid and available assets. So now you have to look at your assets and quantify how much is available for general expenditures for the next year from your balance sheet date. Then on the qualitative basis, you have to now disclose how you actually manage your liquidity. For example, you can say things like, we have a line of credit. We maintain cash on hand for X number of days to meet our payroll expenses and so forth. So we actually have an example, the next slide here. This is an example of, there's actually a number of examples that were put out by AICPA. So if you go to the AICPA's non-for-profit section, it is a membership section. They have a lot of examples on this. But what I have been advising my clients are to actually start drafting this disclosure right away. So you can actually, bring that to your committee, to your management, also share with your auditors to have their buy-in, to make sure this is written carefully to tell the public how you have, what is your financial viability? What do you have to, how much assets do you have to actually use for your general operations? So for example, say like you have cash in hand of X number of dollars. Obviously, it is liquid. It can be converted to cash right away. But if you have a specific restriction on that cash, so if a donor gave you X amount of dollars and said, okay, you have to maintain this in a separate bank account and you cannot use this for anything else other than this particular program. So now you have liquid assets, but that asset is not available for your general operations because it is restricted for something very specific. So you would actually have to eliminate that in your disclosure here. You can say this is my total cash. However, I have to deduct X number of dollars because it is not available for general operations. So I think you have to be careful as to how you draft this note. There were a lot of questions as to if you have board designated funds, would that be considered available for general operations? That's a great question. But one thing here is if the board designated fund is specifically for a particular project, for example, if you have board designated investments for capital projects, now you have assets that are liquid, but it is still not available for general operations. So I think this is also one time you can actually go back and look at your board designated funds and see if you need to make any resolution to free up some of those assets so you don't look terrible in this disclosure. You don't want to come to a section that you have a negative number. So some nonprofits may have that issue, but now in the current presentation, it is not that straightforward to really figure that out to an average reader. But with this new disclosure, you're going to actually disclose that in the notes, and it'll be much clearer to the reader as well. So this is probably one area you want to spend some time, have the buy-in from management, your finance committee, and draft a note. So when the time comes, you're not rushing. And I also would strongly suggest, you can look at the examples, but I think you want to make this note your own because you are telling the story of your organization to the readers, to the financials. So the next section, expenses. If you already prepare a statement of functional expense as part of your financial statements, this is not going to take you that long to implement. However, if you are a nonprofit that don't prepare a statement of functional expenses, this may take some additional time. But then again, you're already doing this for 990 reporting purposes, unless you are a C6 or if you're a C3 organization, you're already reporting your expenses by function and natural category on your 990. So this should not be a huge challenge, but again, depending on each organization is different. So the new requirement is you need your expenses by natural and function at one place. What does that mean? Natural is salaries, occupancy, depreciation. That is the natural category. The function is, as we all know, program, management, and fundraising. So you have to take your expenses and report it by nature and by function in one place. You can put this as a basic financial statement. That would be the most appropriate or easier way to do this. And that's what I'm recommending most of my clients, but I have only very few clients who don't already do that. But you choose not to present it on as a basic financial, you can actually do this in the notes. If you have a note disclosure that actually lists all your expenses by nature and by function, that will satisfy the requirement. One thing I do want to mention is if you currently do this as a supplemental schedule to your financials, that is not going to actually meet the new standards. Supplemental schedules are not part of the basic financials. So if you currently do it as a supplemental, just talk to your auditors and just move it to as a basic financial statement, which is the front 3-4 pages of the financials. That would satisfy the requirement. Supplemental schedule does not meet the requirement. What else under expense reporting? So currently, some expenses have to be allocated between different functions, and most nonprofits have a methodology in place as to how you allocate certain expenses. For example, if you have rent and you want to allocate between program management and fundraising, you may be using the square footage, right, or FTEs. If you have employees that work in multiple departments, you may use time study or timesheets or an estimate of their time based on their job descriptions and so forth. So if you now you with the new standard, you're actually required to disclose that methodology in the notes to the financials. So one thing I have, again, this is probably one thing you can start doing now if you don't already have this in place, is to actually develop a formal cost allocation plan or a functional allocation methodology and have that as part of your accounting manual. So write it up as part of your accounting manual. So by the time the standards become effective, you already have it in writing and you have it approved by the committees that need to approve those type of internal policies, and also have the buy-in from your auditors. I would also say that this is also probably a time you can take a closer, refreshing look at your current allocation methodology and see if there is some room for improvement. I'm advising my clients to do that. Sometimes you set up a methodology and you keep following it every year, but I think this is probably reminds you that, okay, let's take another look at our current methodology and refresh it if we need to. The ASU also give you enhanced guidance as to what could be a administration expense, which is, right now it is not defined that well, but with the new ASU, you will have more examples and guidance under what an administration expense would be. So let's look at an example how this would look like when you implement this. This is a very simple, basic financial statement where you present your expenses by nature and by function. We would call this as a statement of functional expenses. So that is right there. We also have a disclosure on an example of what your write-up would look in the notes as to how your allocation methodology. This is a very simple example as to how you would do it in the notes to the financials. Again, I think you want to make sure it reflects your organization. Every nonprofit is unique. The way I would look at is, if you'd like to look at your total expenses, 50 to 60% of your expenses is probably salaries. Then you look at your next big ticket items, rent, insurance, occupancy, and then target on those sections to see how you allocate them between programs. And even in salaries, if you take a closer look, you will see that maybe 60 to 70% of your employees only work in one department. So there is no allocation there. They're just directly charged to that function. However, you may have that 20 to 30% of your employees that actually works in multiple departments, and that is where you want to focus as to how you allocate those 20 to 30% of your employees, and that is what you will disclose in the notes to the financials. Moving on to the next section, which is reporting investment return. Actually, this, I think, makes life much easier for nonprofits on how you report investment return. So currently, there is a requirement if you have investment expenses that you need to disclose that investment expenses. With the new standards, you could simply have one line of all your investment activities on a net basis right on your statement of activities called investment return net. You can net your expenses related to the investments. You don't need to break that out anymore. So it actually simplifies the presentation. Also, currently, if you break out unrealized gain and interest and dividends and realized gain, you don't require to do that anymore. You don't require to do that in the notes or on the face. So you could just have one line, investment return net, net of everything, no disaggregation. However, I do want to warn you, you still need that information for your 990 reporting because you have to exclude unrealized gains from the 990. It's a reconciling item. So you still need to track it. However, for financial reporting purposes, you can show net basis. Talking to my clients, most of them would simply just leave the disclosure as it is in the notes, just breaking out the realized and unrealized. They feel that is more meaningful to the readers. But again, now you have a choice. You don't have to do it. The investment expenses always was a challenge. It is always difficult to find the exact amount of investment expenses because sometimes you don't know what the fees are charged on some of your mutual funds and so forth. So I think netting it actually makes it simpler and meaningful to the reader. So the last item on the financial reporting standards is operating cash flows. Unfortunately, FASB did not eliminate the requirement to have a cash flow. You still need to prepare it, but now you have an option. So there are two types of cash flow methods. One is direct method and one is indirect method. And if I have to take my client base, almost 99% of my clients use indirect method. And I think that is across, that kind of reflects the practice across the industry. So FASB felt that, direct method, which is the top section that you're seeing here, is more meaningful and easier to understand for general public. So under the current requirements, if you chose to present direct cash flow, you are still required to provide an indirect reconciliation. So you almost have to do both under the current standards. However, going forward, if you choose to just present the direct cash flow, you don't need to prepare the indirect method reconciliation. So it actually makes it simpler and more attractive to preparers if you want to choose to go with the direct method. Again, I think it makes telling your financial story much more easier. You have to look at the readers of your financial statements. You have to look at have conversations with your board and your finance committee as to if you want to change from indirect to direct. I haven't really gotten a huge feedback as to from my client base. They all pretty much want to keep it the way it is, most of them. But if anybody wants to change, this is probably a year to do that. So that's really the end of the financial reporting standards. I do want to just check with Mac at this point to see if we have any questions that came in so far.
Nope, you're good. It seems like everybody's keeping up. We don't have any questions yet.
Wonderful. All right, so let's go to the next section, which is the new standard that came out last week, as I said. This is, if you're familiar with the revenue recognition standards, the RevRec standard that came out a few years ago, which is causing a lot of debate and discussions and challenges in the for-profit world, it does have some impact to the nonprofit world as well. So that was the standard which said accounting for revenue when you have contract with customers. So when that standard came out, FASB felt, okay, this is not going to cover every source of revenue that the non-for-profits receive. For example, if you receive contributions, the standard that came out, which I'm going to refer to as topic 606, that is what it is called. So the 606 is not going to cover contributions. And also, there is a practice in the industry when you have government funding. The challenge is government funding an exchange transaction or a contribution? So there's a whole debate about this, and most of the practitioners and preparers feel that government is not in the business of giving contributions. So it is not a contribution. It should be an exchange transaction. Exchange means when you get a return benefit. For example, when you go to Starbucks and you pay and you get coffee, and that is a return direct benefit. So this standard actually clarifies how you account for government grants and contributions. I want to put something out there up front. I don't believe this is going to significantly change the way you account for contributions and government grants currently. That was not the intent of FASB. It was a clarification. So you could actually go into your statement of activities and pick out each line and say which standard applies. Is it 606 or is it the new ASU 2018-08? So you could actually do that with this new standard. That is the purpose. It was really a clarification of how you account for certain things. So let's look at, there's a lot of big chart here, but I will just highlight the big two items here. So why did FASB come out with this? Because they wanted to clarify how you account for government grants and contributions. And one thing that FASB made very clear out of this standard is government grants are not exchange transactions in general. Each grant is different. So I'm just looking at it at a very high level. They fall more in the non-exchange section, which is the reciprocal versus non-reciprocal. It is the same as exchange versus non-exchange. So FASB wanted to clarify two issues. One, what is an exchange transaction versus non-exchange? And also wanted to define what a conditional contribution versus an unconditional contribution is. And those are the two issues that we're going to dive a little bit deeper in the next few slides. So in the current practice, you see on the top section, when you have a direct benefit back, for example, a student goes and enroll in a college and pays the tuition, gets education back. It's a direct benefit. That is an exchange transaction. That is a no-brainer. It's easy to follow. You go and buy something, you get something returned directly, direct benefit, exchange transaction. In the current practice, there is a perception when governments give out grants or if you get government funding that benefits the general public. For example, you have a grant to run a homeless shelter. So in the current practice, there is a feeling, okay, it is benefiting the general public, so government is getting something in return. So it is an exchange transaction. So FASB came out and said that is the second section of this slide. The proposed, actually it should say the final ASU because this slide was put a while back. It is not proposed anymore. It is the new standard. So now FASB said, you know what, if the general public is actually getting the benefit out of this government grant, it is not an exchange transaction. It is a non-exchange transaction. What that means is if you get a government grant to run a homeless shelter, the government is not getting any direct benefit back. It is the public that is getting the benefit. So it actually falls into non-exchange section. So what does that mean? So exchange means you recognize revenue when you meet certain thresholds. So if it is an exchange transaction, topic 606 applies, which is revenue for contract with customers, which was issued a few years ago. If it is a non-exchange transaction, contribution guidance applies. So does that mean now government grants, most government grants would be considered contributions? That is correct. Does that mean you have to change the way you label them on your statement of activities? No, you can keep it the same way. So now you have to actually fall into the non-exchange. Now it is considered contribution. Does that mean we have to pick the whole grant amount right up front? That is what contributions accounting tell you. That is all. The answer is no, you don't. Because that is the next slide we're going to go into, which is called reciprocal versus non. I think we already discussed this, so I'm going to actually skip this slide. This is the exchange versus non-exchange. So now you have most government grants that are going to be classified as contribution. However, they're going to fall into something called conditional contribution. So what does that mean? Currently, in the current guidance, conditional versus unconditional have a lot of probability judgment. For example, if you get a grant and it has all these terms and conditions and you say it's a contribution, but is it really conditional contribution? No, you know why? Because we have been doing this for the last 20 years and the chances of us not doing this in the next year is very remote. So that probability adjustment actually puts that contribution as unconditional. So FASB changed the definition of what a conditional versus unconditional is. So which is the first section on the left, the new ASU. So a contribution is considered conditional if it has a right of return. The right of return could be, so most of the government grants, for example, there are some regulations or even written in the government grant agreement itself that if you don't use the money, you have to return the money. So that makes it the right of return or release. So it meets the first bullet. The second bullet, it has to meet both, by the way. This is the two bullets to make it conditional. If you have a right of return and you have barriers to overcome. This is a very important term. What is a barrier to overcome? I will give you a simple example. So if you have a government grant that said you have to serve 200 meals, that 200 meals is a barrier that you have to overcome. Even though you have served 200 meals with the same grant over the last 10 years, does not make it unconditional. You still need to serve those 200 meals. That is a measurable barrier that you have to overcome. So now you have government grants that kind of falls under the contribution guidance, but all of a sudden it is going to be considered conditional contribution. So when you have conditional contribution, how do you recognize revenue? When you meet the conditions, right? So for example, in a government grant that you have to serve 200 meals, you would recognize the revenue when you actually serve the 200 meal. What that means is you don't pick up the whole grant as restricted upfront. You're still going to recognize revenue the way you did in the past because you have to meet those barriers before you actually recognize the revenue. One other example would be if you have reimbursement grant, cost reimbursement grant. So the cost reimbursement grants have requirements that you must spend the dollars for qualifying expenses or certain expenses. So the fact that you have to spend it on qualifying expenses is a barrier. You cannot just use the money for any operational purposes. You have to spend it for that particular program in a particular way. So that qualifying expenses is a barrier, and almost all government grants have a right of return, so that makes it conditional. So again, in the presentation on the notes to the in the statement of activities, you don't need to change the terms. You can still call it government grants. And mostly you are going to recognize revenue the way you've been doing it over the past years. But this again clarifies and provides guidance to the existing standards. Let's look at the next slide, what one would consider to be a barrier. The barrier had to be measurable. I think the best example is, serving X number of meals or serving X number of homeless people, or you have a target, you have a measurable barrier. So these are some of the indicators of barrier. There's a lot of examples in the final ASU. If you haven't read it, I actually would encourage you to do it. If you go to FASB's website, they have put out a video. They are going to be doing a webinar sometime in September for this standard. So I would recommend, familiarize yourself with the standard, because again, it is more of a clarification than the changing the way you're doing it. Excuse me. This is a slide that I actually developed internally. When the 606 came out and when the new standard that came out last week, I developed this slide a while back. I said, okay, we don't want to read these 200 pages and try to figure out how I'm going to account for all the revenue sources that is going to come into the organization. Can I just see it in one place in a much simpler way? And that's why I did this. So the best approach would be, you have to take your statement of activities and look at all your sources of revenue and see where it fits. Is it going to be under ASU, the 606 topic, which is contract with customers, or is it going to be under the new ASU that came out last week? Once you divide up, between these two guidance, then you just need to follow the guidance to apply and recognize revenue. And how does any revenue source get differentiated between these two sections? The piece here, the most important piece here is exchange versus non-exchange. Unless the resource provider or whoever is giving you the grant have a direct benefit, it is going to be non-exchange. So private grants, for example, if you have a private foundation that gives you grant, most of the time the private foundation is not getting any direct benefit back. It's actually helping you to run the programs, and it's benefiting the general public. So that would fall under the non-exchange, and thus the new ASU standards will apply. So that is the first exercise I would do. Look at every revenue source, figure out if it is exchange versus non-exchange. If it is exchange, you would just go into 606, and I have listed 5 items here for you to complete before you recognize the revenue. You have to identify a contract. You have to have performance obligations. I'll give you a very simple example really quick. So a student goes and enroll in a college. So that enrolling is the contract. What is the performance obligation? The performance obligation is the college have to educate the child. So that education, once you meet that education, once you provide those education, you can actually now recognize the revenue. So those are that 5-step process under 606. If the source of revenue falls under non-exchange, the new standards apply. Then you have to figure out if it's going to be conditional versus unconditional. Conditional is, again, when you have a right of return and when you have to overcome a barrier. So there will be questions as to what is a barrier versus a restriction. And that is where the ASU's examples will come into play. The barrier should be measurable, and it is very clear as to exactly what you have to do. So that's why most government grants does tell you what you need to do to recognize the revenue, and that is a barrier. If a private foundation gives you a grant and say, okay, you have to spend it for this particular program, that is a restriction. So again, there is a lot of clarification here. I would encourage you to attend the FASB webinar in September, and also have discussions with your accountants and auditors to make sure you're ahead of the curve as to how, if there needs to be any change or not in the way you are recognizing each line items on your statement of activities. So that's the end of the presentation. I know we're a little bit early. I'm going to turn it over to Mac to see if we have any questions. I didn't see anything that came in here, but if you have any questions, feel free to type in. I'll be happy to answer. Mac, it is yours.
So we do have one. Bonita wants you to confirm conditional grants received are not recognized as revenue until all barriers are fulfilled.
That is correct. So if you have a contribution that is conditional, you have to meet those conditions to recognize the revenue. That is correct.
Okay. And Lauren wants to know, what would be an example of a right to return or a right to release?
Okay, so the best example is government grants. So if you have government grants, it is either written in the grant agreement itself that we are going to fund this particular program, and any unused money must be returned to us. That is an explicit right to return. That is the most common example I can think of. Most private foundation grants, some of them may have that clause in their grant agreement, but again, to make it conditional, you need to have both. So just because the private foundation grant may say, okay, any unused monies must be returned, it doesn't make it conditional if it doesn't meet the second bullet, which is the barrier to overcome. So again, the example is, I would say, if you read any government grants, they all have a clause that there is a right to return.
All right, excellent. And Lauren continues. She said, would a grant be conditional if there's a barrier but no? I'm sorry, getting more than one question now. Lauren keeps moving. Where'd she go? Oh gosh, I lost her. Okay, there you go. Would a grant be conditional if there's a barrier but no right to return?
No, it has to have both.
Okay. All right, let me see what else we have here. Here's another question. We received funding to manage a homeless shelter. Would this fall under the new guidance?
That is a very general question. First of all, I have to see the contract itself. However, based on my experience, I can give you a general answer. If it is a government grant to run a homeless shelter, the chances are it is going to fall under conditional contribution guidance. Again, you're not going to change the caption on the statement of activities, and it will probably have barriers that you have to overcome, which is you have to provide homeless shelter to X number of homeless folks, and also it will have a right of return. So generally, yes, but this standard actually makes you that you have to actually go and read those exciting contracts, which are 30, 40, 100 pages long, then decide where it actually fits. But again, generally speaking, it would fall under conditional contribution, and you would recognize revenue the way you have been recognizing revenue in the past. Yeah.
Okay. All right. What about private contributions earmarked for a specific program or purpose? Are these still considered conditional contributions if there is no right of return?
Excellent question. If it is earmarked for a particular program and there is no clause for right of return, it would be a restricted contribution and falls under unconditional contribution with restrictions, just like you have been accounting for it now. So
Okay.
it won't be a conditional because, again, you have to have both right of return and barrier to overcome.
All righty. Victor wants to know if a grant agreement does not specify return of unused funds, but requires the funds to be used over 3 years, will that make it time restricted?
So if I'm getting the question right, you have a grant that have no right of return, but just explicitly say that you have to use it over 3 years, and I'm assuming you may have a 3-year budget or something that how much you spend each year. It makes it time restricted, yes, but then the next question is, does it also have the clause that you have to spend it for a specific program over the 3 years? Then it is purpose restriction comes first. So if it doesn't have a purpose restriction, and if it is just strictly limiting the use of the funds in the future years, it is time restricted.
Okay. And along the same lines, should the revenue be recognized evenly over the 3 years from a 3-year grant, or all the funds can be recognized on the date received?
Great question. So again, let's go back to this chart here. So I'm going to take the position that this grant is a non-exchange grant, so it falls under the contribution guidance, and then we're going to assume this is an unconditional contribution because it doesn't have the right of return and barrier to overcome. So now you have an unconditional contribution that you received this year, but the donor or the resource provider said you cannot use the monies this year. You must use it over the 3 years, X amount of dollars each year. If that is the case, you have an unconditional time restricted grant, which means you pick up the whole amount the first year and you release it over the 3 years from restricted to unrestricted.
All right, and we'll do one more. Is the revenue recognition rule, recognized when the barriers are met, a current rule or only in the new reporting guidelines? Is it current or is it brand new?
Okay, so the concept of, so this is what FASB did, right? But this is a new standard, which again I said came out last week. So they redefined what conditional means. So in the current guidance, there is nothing called a barrier to overcome concept. So this is new. So the conditional part, the definition of what a conditional grant is new. The old definition, the most common conditional grant is matching grant. So if you had a grant that you have to match, that is conditional. Everything else kind of pretty much fall under unconditional because we use a probability assessment as to, oh, what are the chances we are not going to do this, so we're going to make it unconditional. So to answer the question, the concept of barrier to overcome and the definition and all that is brand new, that came out last week.
All right, excellent. You want to keep going, or they keep kind of trickling in on you?
Fine, yes, go ahead.
Okay.
I mean, we have another 5 minutes.
All right. So Paula has a question. What if you have a government contract that is cost reimbursement and the agreement requires a publication of research results? The question is, the costs are incurred prior to the publication. Do you need to defer the revenue until publication?
So you have government grant. So I'm a little bit confused because it said it is cost reimbursement.
Right.
So let's say this grant is going to fall under the conditional contribution guidance. And when would you recognize the revenue? The question is, okay, we are incurring the cost up front, but the publication is not going to be done until the next 6 months. So should we wait till the publication is done to recognize the revenue? Is that the question?
I think that's what she's asking, yes.
Yeah, I think that is the question. So again, it depends on the contract, right? If the contract is saying you are entitled, or you can recognize the revenue, or we are going to reimburse you for us, you incur the cost. For example, say like you incurred the cost and for whatever reason the publication didn't happen, does that mean you have to give all that cost back to the government? So you have to read the agreement to see, if it makes a performance-based contract versus a cost reimbursement contract. A performance-based contract would be you have to meet that milestone to get the money, which is you have to have the publication to be entitled to the revenue. In this case, since the question is worded that it is cost reimbursement, I would say you will recognize the revenue as you incur the cost. Again, you have to read the agreement to really have the clear answer. But generally speaking, cost reimbursement contracts, you recognize revenue as you incur expenses, you put in the invoice or the claims, you get paid, and you move on.
Okay. One attendee says that they received private grant dollars for a specific program with no barriers or requirements to meet any performance goals. The only requirement is to provide an income statement for the program and if funds are returned. Does that fall under conditional?
It does not sound like it falls under conditional. Just having the requirement to give a financial statement is very administrative. That is not a true barrier. So it sounds like it is going to fall under unconditional and may be restricted if it is restricted for a particular program.
Okay. Well, Sibi, I think you have satisfied the audience. We don't have any more questions. Like we said, there will be a poll that will pop up when I close the webinar that you'll need to complete to get your CPE. If you can't do it right now, you'll get a copy of that same poll via email in about an hour. And that email will also contain a link to Sibi's slide deck. Well, thank you, sir. I hope you have a good holiday.
Thank you. Thank you, everyone. Have a fabulous rest of the day.
All right. Travel safe, everyone, this weekend. Bye-bye.
Okay, bye.